Hello, traders. This is Dave with the Compass Options Trading Room and Alert Service. I just wanted to do a fairly quick video tonight. I use a particular strategy called time spreads over earnings, and I don't really think that people understand how effective this is. So I wanted to put out a video to try to show how effective this strategy is for trading over options, trading over earnings. There really are no there are no profitable strategies trading over earnings except this one, as far as I know. You don't know which way a stock's going to go. You don't know how far it's going to go, up, down, or otherwise. So basically, you've got to come up with something that's a non-directional trade that can make money for you. And the time spreads, it's actually a calendar spread. The time spreads that I use over earnings have been very, very successful over the last 2.5 years. And I use them in the room, and I use them on the alert service. And I just wanted to share them with traders to make them aware of them. They can take advantage of it. Basically, it's just some information for anybody that would like to trade earnings successfully, be consistently profitable on them. So I call them time spreads. So again, my name is Dave. I'm with the Compass Options Text Alert Service in the live trading room. I have a live trading room that I run 5 days a week, Monday through Friday, market open to market close. And I also have a text alert service where we send out high probability trade setups. And some of those are time spreads. And not all of them, but some of them are time spreads if the criteria is set up. So I wanted to share this with you. I think you'll find it a great strategy once you know how to find the criteria and trade off of them. All right, so again, I have to do a disclaimer. All the signals and trading opportunities we provide here for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, so this basically is just a graphic of what the alert service looks like. I send out alerts, high probability trades to all the alert members. I have lots and lots of alert members, and the time spreads are some of the things that we send out, as well as several other trades. But tonight I want to focus on time spreads because I think it's a really overlooked strategy that people don't take advantage of. Traders don't take advantage of it. So I'm going to try to explain to you how these work, why they work, and why they're so successful. All right, so in the room, by the way, we have some rules to trade by. We trade the best and skip the rest. Sounds simple, it's not, but we do try to find the highest probability trade setups. And then we also, our objective is not to make trades in the room. Our objective is to make money. We don't just take trades willy-nilly. We're only looking for high probability trade setups. You have to be very patient to be consistently profitable as a trader. All right, so we have an edge. We need an edge over other retail traders. That's who we're trading against. We're not trading against institutions. We're following the institutions. We have a compass system, a right line compass system that tells us if the institution is in the trade or not. We also trade relative strength and relative weakness. We trade with the market trend if there is one, and we look to buy near support and near sell near resistance. Now this has nothing to do, this is with our normal trades. When we're not trading around earnings, we're just trading normally with intraday trades or swing trades, short-term swing trades. This is the kind of edges that we have, and this is what we use. Tonight we're going to talk about time spreads. Now, what I've done here is I've just kind of laid out the time spreads that we've taken. I think I got most of them here from the first of the year. And of course, time spreads obviously are relevant during earnings season, right after earnings season begins. So you get gaps where you don't have an awful lot of opportunities, but every quarter you have a lot of opportunities. So these are some recent time spreads we've taken. My overall win rate on this over the last 2.5 years or so has been a little over 85%. And I'll just kind of lay out some of the trades that we've had here since the first of the year. And I think this is most of them. It's not all of them, but it's a lot of them. And you can see we have, like here we started with 17th of January, which was earnings comes out. We had AA here, Alcoa, 37%, and then we had Pfizer, just a 7% win. Las Vegas stands 35%. So you can see the percentages we got. We had a few losers in here. We haven't had a lot lately. We had a few back in here. And sometimes they can go against you. And you can make adjustments to these trades too, by the way, to try to mitigate any kind of losses that you might take. But again, we had some nice wins here. HPQ 100% here, PATH 67%, APP 61%, pretty nice wins. FTNT 50%, RCL 50%. So pretty nice wins here on these time spreads. That was through March. These are the time spreads since then. These are the time spreads since March and April. Again, you can see here we've had about 12 here without any losses on here. 37% here, 45%, 45%, 72% on XP, 84% in Ford. So some nice, the win percentages are pretty high on these. Again, not every single one will work, but if you get the criteria right, these are very, very profitable. And again, we've had 28 wins and 4 losses, 87.5% win rate since the first of the year. Now, these are the since I don't alert on every single trade because sometimes we take them too late in the day to alert on them. But these are the alerted trades for May, and you can see here the ones I got in yellow. These are the time spreads that we've taken in May. The other ones are standard trades. Most of these are. This is a debit spread here, but most of these are straight puts and straight calls. And you can see this XP was 71%, 38% on TJX, 48% on AMAT, Applied Materials, 40% in Akamai, and Hershey's 30%. So pretty nice percentage wins on these time spreads. For the alert service, we've alerted 12 trades so far in May. $2,000 invested each trade netted $7,892. That's pretty good, and that's just an arbitrary number. I just have to have something that I can compare month to month to show what kind of results we're getting. Obviously, you can trade 500, you can trade 1,000, you can trade 10,000, and the profit would just be adjusted based on the percentage. But you can see this, the alert service has done really, really well, and you can see here we've had 5 of these 12 trades with time spreads, and we won on every single one of them. So this is something that I think a lot of people overlook and may not even be aware of. They're called calendar spreads, but we use specific dates on the expirations on these. So that's why we call them a time spread. So I'm going to get into this a little bit here. Time spreads, again, it's the only strategy I use over earnings. It's a time spread on stocks reporting earnings after the close today or before the open the following day. So we open these trades just before sometimes lunchtime on, but the day of earnings, which would be then after the close or before the open in the morning. So we're going to put this trade just prior to earnings being released. Now, how this trade makes money, the trade is meant to capture the difference in the implied volatility crush and the time decay between this week's and next week's options. So the reason that this works is we'll get into this a bit about your IV crush, what IV crush is as far as earnings are concerned. The trade works best on stocks that historically don't exceed their expected move, not their expected earnings. This has nothing to do with the earnings that the stock makes. It's just they have expected moves that the market makers build into the trade. If they think the stock is going to move 12%, then they price their options to expect a 12% move. But there are ways to find the historical record of these trades or of these companies. And I'm looking for stocks on companies that historically don't beat the expected move more than 20% of the time. I'm looking for stocks that basically come in less than the expected move 80% of the time or more. And there's a lot of them like that. So that's what we're looking for, right? So again, we're looking for stocks that don't historically exceed their expected move after the earnings release, so we can harvest the premiums from the options to be profitable. The time spreads are entered for a debit, and that is the total risk on the trade. And they should be entered as one transaction. In other words, you're going to sell a call for this week and buy a call for next week. So you put it in as one trade. There's going to be a debit. That is your maximum loss. You can't lose any more than what you put into the time spread. Now, the time spreads are initiated on stocks, again, that report earnings tonight or tomorrow morning before the open, and it consists of selling this week's expiration at the money calls. I use calls. You can do puts, but I use calls. So it consists of selling this week's expiration at the money calls and buying next week's calls, next week's expiration date at the same strike. So if we're doing a time spread on Microsoft, for example, and it's trading at about 100, and they're having earnings tonight, then we would sell this week's $100 call and buy next week's $100 call. Okay, so you're getting a credit on this week's call and a debit on next week's call. It's going to be a debit to your account because next week's calls will be more expensive than this week's calls. So then that's what you put on. After the earnings are released, the implied volatility that's built into these option premiums, they're going to drain or be crushed. That's where the term IV crush comes from, because the market makers have basically jacked up the premiums on the options to protect themselves because they don't know which way the stock's going to move or how much it's going to move. So they go in there and they put their expectations into the premiums on the options, right? So there's a big implied volatility put into these options. And after the earnings come out, this implied volatility will be drained from the premium, so the premium values will go down. And for both this week's and next week's options. However, the IV is always higher in this week's options than it is for next week because it's closer to the earnings date. So you've got a higher IV that's going to be drained when the earnings come out, and that's why we're selling this week's calls, because we want to capture the IV crush from this week's calls. Additionally, there's going to be some time decay impact on these. Remember, the time decay on this week's calls is going to be a lot faster than the time decay on next week's calls. Next week's calls are going to decay more slowly. So we will also capture the difference between the time decay between this week's calls and next week's calls. So we're capturing the implied volatility difference, and we're capturing the time decay difference between calls for this week and calls for next week. That's why we sell this week's calls and buy next week's call. And again, the time decay will impact this week's options more than next week, as I just said. This is going to allow you to buy back this week's options and sell next week's options for a profit from generally from 15 to 50% when the earnings come out, unless the stock moves way outside of the expected range. This is typically what I'll put an order in there, good to cancel before the earnings come out, to try to capture the move as quickly as possible. Because a lot of times when the earnings are released, the option premiums get skewed. They get skewed because they're adjusting the implied volatility at that point. So what you can end up with is really a wide spread on the bid ask on any kind of option, on the call option. And what happens is you can actually get filled for more than what you expected to. An example would be this applied materials that we did. I get in for $1.25 and I put a sell order in for $2 for the morning. And even though I had a sell order for $2, I get filled at $2.29 because the spreads were so wide. Some of the folks in the room got filled for about $2.45, so worked pretty good. So this is the time spreads. Okay, now let's talk about volatility crush just so you can understand this. So again, it's volatility is the additional premium included in the options prior to the earnings due to the uncertainty of the stock price reaction to the earnings report. They don't know how much it's going to go and which direction it's going to go. So they increase the premium on the options. That's the implied volatility. Immediately after earnings are released, the additional volatility that was included in the option premium drops rapidly, or it's crushed. That's why they call it IV crush. And since we sold this week's calls, we can buy those calls back a lot cheaper than what we sold them for. So we make money on this week's calls because the IV crush is coming out of there. And again, if you select stocks that have specific criteria just prior to earnings, the volatility crush can be captured for a nice profit, as I've shown you in the results that we've had on this. And again, this is a really an overlooked strategy. I just don't know an awful lot of people, traders, that even understand this or take advantage of it. All right, so the majority of trades they're called calendar spreads. All of these trades are going to be called calendar spreads. But I call them a time spread because a calendar spread is just basically selling a call or a put for this week and then buying a call or a put further out in time. But it can be two weeks out, 3 weeks out, 4 weeks out. Time spreads was selling this week's call and buying next week's call. We're only using the current week and the next week's call options. So the time spread is structured to capture the implied volatility drop after the earnings are released, and the difference between this week's option volatility and next week's option volatility. That's what we're capturing, the implied volatility drop. strategy also captures the difference between this week's option time decay and next week's option time decay. All right, so we're capturing these two things. The time decay is the volatility crash is the biggest, but there is some advantage to us also with the time decay. And again, the trade is entered just prior to earnings release. Enter trade in the afternoon before earnings release, occurring after the close or before the next morning. And again, we try to take 20 to 40, 50%. And again, that order should be active before the market opens. So this is the criteria that what we're looking for, right? These are the criteria that we need to have on a stock before I take a time spread on it. Obviously, it's got to have weekly options. You can't take a trade that doesn't have weekly options. The stock is going to have earnings announced after today's market close or prior to open tomorrow morning. All right, so we're getting it just before. We're just trying to capture the implied volatility crush just before earnings comes out. The implied volatility between this week's option and next week's option has to be a large percentage difference of around 40% or more. So if this week's implied volatility, for example, is 150 and next week's implied volatility is 75, then you would have a difference of 75 between this week's and next week's. That's a 50% difference in volatility. That's what you're looking for, a large difference in the volatility between this week's calls and next week's calls. And also, as we mentioned before, historically, the stock should move less than the expected move at least 80% of the time or more. The less frequently it exceeds the expected move, the better. Now remember, this has nothing to do with the earnings, whether they beat earnings, they don't eat earnings, we don't care. We don't even care if they go up, the stock goes up, goes down. We could care less about that. What we're looking for is stocks that historically just do not exceed the expected move after earnings are released, and there's a lot of stocks like that. Some of them beat 80% of the time, 90% of the time. You don't want to mess around with those because they're going to be too far extended. You're not going to be able to take advantage of the volatility crash. You want to, again, enter the trade in the afternoon prior to tonight or tomorrow morning's earnings release and close the trade for a profit after the market opens if possible. 20 to 40, it depends. I mean, you could set a 50% target and there's 60% sometimes. If the stock price moves more than the expected move, may have to take a loss or make an adjustment on it, which we can do. We can make adjustments to these. A lot of times, if you have a stock, for example, that you're selling a call and the stock expected to move 10% and it moves down 20%, so the stock's way underneath your strike price, what you do is you let this week's call expire worthless to keep the money. You keep the premium on the short call, and then you hold next week's call in case you get a bounce in the stock, where the next week's call can go up in value. And there's some other things we do to make adjustments to this. But this is the criteria that you've got to have. If you've got these criteria and you do a time spread, you're gonna likely be able to make profits on these trades 85 to 90% of the time. And I don't know too many other strategies can do that. I know there are no other earning strategies because you're trying to guess. I mean, if you're doing strangles or straddles on an earning, basically as soon as it moves outside of the it stays inside the range. If they're expecting a 10% move and you take a straddle or a strangle and it moves 8%, you're going to lose on puts and the calls. So that doesn't work. And assuming you know how the stock's going to react to earnings, that doesn't work because stocks don't necessarily, because they have a good earnings, doesn't mean they're going to go up. I'm sure you've seen stocks that reported great earnings and dropped 15%. So if you're trying to do analysis on that, good luck. You're not going to be able to determine which way the stock's going to go. And any options that you buy, if you're buying a straight call or a straight put to try to predict direction, that stock has got to outperform the expected move by a lot just to cover how much you're paying for those premiums. So that is the time spread information. Just kind of a recap here of this is our first quarter trading results in the trading room and our alert service. Trading room 65 wins, 11 losses, from 86% win rate, a little over 18,000 if you put 2,000 into each trade. This is just again a baseline that I use just so I've got something to compare it against. The alert service 41 wins, 6 losses, 87% win rate, $12,224 on the first quarter for just 47 trades, which is pretty nice. And the strategies we use in the room, besides the time spread right here that I've got specified, to capture the volatility crest. We do straight calls and straight puts. We do debit spreads, usually weekly options expiration. This is a really successful strategy. It's another strategy that I can go into. I have a video on it. We have another strategy called the weekly ATM strategy. This captures premium week after week by selling puts on a longer dated put to capture time decay week after week. I also do some credit spreads quite often when the market is neutral to bullish. And I also do some intraday trades inside the room. These are not alerted, called the SPY super system. When we have the SPY being sold by the institutions, and also the market internals are lined up with it, and then I'll go ahead and buy puts or calls on the Qs in the SPY. But those trades only last normally for 4 or 5 candles. So these are the strategies we use in the room. But I did want to get into the time spreads tonight, because it's something that a lot of people, I don't think they're aware of this strategy. And if you take your time when earnings are out and look for a few stocks that meet this kind of criteria, I think you're going to be able to increase your profitability. You'll also have a nice strategy to use over earnings, because a lot of times you can't trade over earnings. This is a way you can trade over earnings. Normally you got to wait for earnings to come out and the stock to settle down before you do any kind of trading on it. But here's a strategy that you can use to do earnings for you. So that's the time spreads. I wanted to spend some time on it. I think it's way underrated as far as a strategy to use. And so I thought I would share this with everybody. Obviously, I share it in the room in our alert service, but I thought I'd share this with everybody. You can see what we do, one of the strategies used in the room. And if you like it and you think that this is something you'd like to use, you can try it. You can join me in the room, or you can join me on the alert service, and you'll get these sent to you as well. So again, I appreciate your taking some time to listen to this. I hope you find it useful, and I'm trying to build some educational content into this. And I think this is something that will help a lot of traders. So thanks very much for listening to the video. Hope to see some folks in the room and on the alert service pretty soon. Have a great evening.